Hi, everyone. Welcome to the first episode of the new Analyze Your Trade web show for August 22nd, 2017. My name is David Kosmeter. I'm the creator of Timing Research, and tonight we will be discussing your trade ideas in the first episode of this new show. I have Dean Jenkins moderating, so I'm going to go ahead and turn it over to him.
All right, thanks, David. Hey, it's great to be here, and thanks, traders, for attending. Pretty excited. David and I have been brainstorming this show for several months now. Just the idea of, there's lots of webinars where you can go see an educator or a trader or somebody, talk about their system and teach something, and that's cool. I learn a lot from those. But I had a sense in talking to some traders that people just want some trade ideas and maybe to hear from some experts, some successful traders, various viewpoints on different trades. So we're giving this a try, and we're calling it Analyze Your Trade, and it's all about you. So when you signed up, there was a survey, and we've tallied the top 5 stocks that people are interested in, and I'll share that real quick. And it is not a surprising list. But right here, so the top 5 are Apple, symbol AAPL, the S&P 500 ETF, which is by SPY, Amazon, AMZN, Alibaba, BABA, and GLD. So we're definitely going to take a look at those 5, and we've got, kind of a Pareto of some other ones here. We'll take a look at those. And then you're able to also type in your comments, and we'll try to take a few on the fly. We want to analyze as many stock symbols and charts as possible. And David's going to be scribbling like mad and writing down what each of the panelists says about them on a spreadsheet, and then we'll send that out. So you'll have a copy of that where you can look at it. And if you got the 4 of us saying that's a good trade, that might be a good trade, or not. At least you'll hear some different opinions, and you can figure out whose opinion you think you like. And it's unlikely that we're going to agree on everything. But what I'd like to do is just start off and introduce the panel. So we've got Bennett McDowell from TradersCoach.com. We've got Corey Rosenblum from Afraid to Trade, and Dave Landry from DaveLandry.com. So we got BCD. We're just going to go in that alphabetical order. So Bennett, if you just take maybe 2 minutes, introduce yourself, and talk about what are you looking for in a great trade. If you want to share a slide or a chart or something to illustrate that, that would be great. Okay, Bennett, are you muted? I don't hear you. And we'll go to Corey while Bennett's getting it figured out there. We're getting the technology worked out. So Corey, if you'd introduce yourself, what your company, and then what are you looking for in a trade setup?
I think Corey's muted.
Corey, you're muted.
Can you hear me now?
There he is.
All right. Hey, Dean. Hey, everybody.
You can work for Verizon.
I know. Hey, can you hear me now? Greetings, y'all. Thank you for having me. It's an honor to be part of the panel. And this is kind of a good little way to get started with. We're going to the final part of 2017 here. But I am the owner, president of AfraidToTrade.com. Started that in 2007. Went full-time professional in 2006. Started off in that investment world back in 1999 with a lot of people riding the bull market up. And I became involved in technical analysis when the market went down as a way to figure out how to sidestep these bear moves. So a lot of what I do has been similar to Dave Landry's work. He was one of the first people I started listening to and learning from way back when, 2004 or 5. But I became kind of a technical purist. And so I use a lot of chart metrics and try to identify strong stocks getting stronger or weak stocks getting weaker. And I want to trade retracements into those. I like kind of the Dow theory concept of confirmation, non-confirmation. And so the best trades that I take on a swing basis are those that have a new high, new price high, and an ongoing uptrend, rising moving averages, higher highs, higher lows. I want to see volume come in and confirm that. So essentially higher price highs, higher moves in volume to confirm it. And I use a special momentum indicator that also has a confirming variable. So if I see price to a new high, uptrend in motion, and momentum confirming, volume confirming, I'm going to be an aggressive buyer of those pullbacks. A majority of what I do is on the intraday basis on the ES future. So I'll talk about that more. A little bit in gold, a little bit in crude oil, but I'll still swing trade some of those leading stocks, and you'll see some of them on this list here. but I'm most comfortably at home on the intraday charts. And I've written the complete trading course book in 2011, speaking on the Money Show and Traders Expo, and seen Bennett a lot, seen Dave a lot, other people at the Expo. So it's good to see friendly faces here at the panel. And yeah, this is actually my 10th year anniversary of working for my company at Afraid to Trade. So I guess 17th year as an investor. So it's an honor to be part of y'all's group today.
All right. Hey, thanks, Corey, for being here. It's exciting. I'm looking forward to hearing your opinion, because we have some different methods that we use, and so it's always good to get just different perspectives. And again, when you get 2 or 3 or 4 people going, yeah, that's a good trade.
Yeah,
all these
absolutely.
different methods, there might be something to that. So Bennett, we got you?
Dean, can you hear me? Can you hear
Yes.
me?
Yeah, there we go.
Okay, good. I don't know what happened. I think the audio just got killed. My cam is not working, so I'll just leave it on my picture there. Well, it's great to be here. Thank you for having me, and looking forward to it. What I like to do, and Dean, you should know this because we've been together for quite some time. I like to look for markets that have been channeling for quite some time. I do not like to get into trends late. I like to get into the beginning of trends, and I use the Elliott wave. So I like to get into either the beginning of a brand new trend, and we can usually scan for those by looking for channeling or what they call fry pan handle markets, where it's a bottoming type of long-term channel. We also look to get in at the ends of different moves in the Elliott wave. For example, one of our favorite trades is wave 3 to 4, and then of course 4 to 5. And so we look for that as well. So my biggest pet peeve is not getting in late in a trend. I can't tell you how aggravating that was when I first started trading. I would always look for powerful sectors, momentum trades, but the problem is by the time you find them, the herd is already there. And usually what happens is you tend to get in late, correction comes, takes you out, and you're sitting there with the right idea, the wrong timing. That was always the case. So that's what I look for, and when we take a look at the markets today, I'll kind of keep that in mind to whether a trend is extended, ready for a pullback, or maybe it's an opportunity to get in early.
Okay, super. Yeah, and I am familiar with your setups, Bennett, and
I would think you would be.
yeah, we've looked at a lot of charts together, and our methods overlap to a pretty good degree, but with, with some key differences.
You and I should be in line most of the night, I would think.
Yeah, there may be some subtle differences, right? And
yeah,
who knows? I may just disagree with you to be disagreeable. Who knows, right?
Yeah. Okay. Yeah. There you go.
I wouldn't do that. Okay, Dave, if you'd introduce yourself and just overview of the method. What are you looking for in a great stop?
Yeah. Hey, thanks for having me. I'm looking for. I'm slotted as a swing trader, so I'm looking for a market that has the potential to make a short-term move. And predicting a market is akin to predicting the weather. I believe you can only predict the short term. Unfortunately, you really cannot predict the longer term, no matter what anyone says. Neither you or me or the guy who screams on TV, but you can stick around with the trend as long as it moves in your favor. So what I have on the screen, which was a great idea, Dean, to put up an example of a good trade. And this is one we're actually still long. It's KEM. And we got in right around here way back in January. And it took a little while, but we were able to get a nice little profit out within a few weeks. Now, we didn't know that this thing would take off and keep going. Otherwise, we'd have held on all of it. But we don't. More often than not, the best you could do is just a swing trade. And obviously, the worst would be just stopped out at a loss. But in this particular case, we've been holding on for a while. We got a nice little gain in that. The secret sauce to all this is the money and position management. Well, first, obviously, the stock selection is crucial. But then after that, it's the money and position management. And the secret sauce is letting that stop, easy for me to say, letting the stop widen out gradually to make the transition from the shorter term trader to the longer term trader. When somebody asks me what my holding period is, I tell them 10 years or hopefully longer, but obviously I'm going to get stopped out long before that. And then obviously a crucial part that's often missing is psychology, and I've been doing more and more work with that in more recent years. And the greatest methodology in the world, as you guys know, is worthless if you don't have the psychology to follow it. As far as my bio, I'm not going to bore you with that. You get off my website, but I've worked with several hedge funds and I've worked with thousands of individuals on the retail side. I've been around for a while, as Corey kind of pointed out. I stopped counting after 20-something years. But if you want to find out more about the methodology, I have plenty of information on my website. I also have around 1,700 YouTube videos last count. And I do a weekly show called Dave Langer's The Week in Charts, and I'll lecture for a few minutes, sometimes a little bit longer than that, cover a subject, either money management, setup, psychology, etc. And then the remainder of the show is exactly what we're doing tonight, looking at stocks and seeing which ones we like, which ones we don't, and why relative to the methodology. So when David said, hey, Dean's got this great idea, I'm like, I'm all over it. Let's do it. So good idea there, Dean. And I think that pretty much sums it up.
All right. Hey, thanks. And it's good to have you here, Dave. All right. Well, I'm Dean Jenkins, founder of FollowMeTrades.com. And I've been trading about 20 years, but I've been a technical trader for about seven years. And, you know, people now ask me, you know, don't you care about fundamentals? And I say kind of tongue in cheek, you know, if I want to know whether to take an umbrella, I don't go look at radar maps, man. I just look out the window, right? I just need to see the result of what's going on. And for me, technical analysis is that. You know, fundamental analysis, fundamental data absolutely matters, right? But the market's already responded to it. It's, you know, it's the efficient market theory. Everybody's got the same information. I don't need to go read it. I just need to see how they're responding, and it shows up perfectly in price. So I'm a pure technical trader, right? The only thing I check for before I take a trade is, you know, is there a big announcement, earnings, or a drug approval, or are they going into Chapter 11 or an M&A? I care about that because it's disruptive. But other than that, what's their earnings? Who's their CEO? Don't care. I care about what's going on with price, right, and volume and the technicals of it. So let me share a quick chart here, and because this just shows my method that I use for trading. Just a quick slide. So I use Elliot Wave. We actually have the guy on the call today who wrote the book on Elliot Wave, at least Elliot Wave Techniques Simplified, a simple, repeatable method. And that's Bennett McDowell. He wrote the book, and I was honored to contribute a chapter to that book as well. So we both use a similar approach. In Elliot Wave, I try to catch, you know, wave 3 is so easy to spot. It's a big impulsive move. It's the biggest move on the chart, right? So we'd like to catch that when it's coming out. If we miss that, there may be profit in the correction down to 4. And if 4 didn't have enough profit, once you've got a wave 1, 2, 3, and 4, there's a pretty high probability you're going to get a wave 5. And so you can see I've got Ichimoku Cloud on there. I use Ichimoku Cloud as a confirmation that the trend is beginning. So when we're breaking out into the first impulsive move, I like to see a break above the cloud, and I like to sprinkle in just a little bit of Dow theory, right? I like to see a high, higher, low, new high, breaking above the cloud, just like it is on that chart there. And then when we're catching wave 5, same thing. You can see, you know, we had a high, higher, low, new high, right above the cloud. We got a great target zone projected with Fibonacci extensions. And I don't take a trade that doesn't have a bigger potential win than it does a loss, right? I want a high reward to risk ratio, right? Dave made a comment about the importance of risk management, trade management. I couldn't agree more. You know, in a trending market, I think you could throw a dart and be a profitable trader if you had good risk management and trade management. You could be all, you know, a 50-50 trader and be very profitable if you had good risk management. Now we can be a lot better than that with good trade setups, right? And a repeatable method. But risk management, trade management, and part of that is only taking trades that have high winning potential, right? Because your win ratio is important, but your payout ratio is way more important, right? Your winners have to be bigger than your losers. So why not take trades that have big win potential relative to what they could lose at the stop? So that's my method in a nutshell. I'm looking for impulsive moves, corrections, and continuations of trends. I use Ichimoku Cloud to confirm it. I use some Dow theory, and I also use Bennett's indicators, the applied reality trading system, on my charts, and you'll see that when we start looking at live charts. All right, well, that's a little bit about your panel. We got through that pretty quick, and I think you got some, you know, different approaches here. You got some real horsepower, and then you got me, but I'll be happy to include my opinion as well. What we're going to do is take a look at that list of top 5 now. And again, the top 5 are Apple, the S&P 500, ETF, SPY, Amazon, Alibaba, and GLD, which is the gold ETF. So we'll just go around the panel there, and we'll look at each one of those symbols. And you know, each panelist, you know, 30 seconds to a minute. take a look at that chart, share that chart if you're able, and give your opinion. What do you think? Is that a good trade? Not a good trade? We'll see. And then David will be keeping records, scribbling furiously, and record that. And then once we go around, each person offers their opinion. We may talk about it and challenge each other's thinking there just a little bit. But Bennett, you're at the top of the batting order here with Apple. So you want to share a chart and let us know what you think about Apple as a trade.
Sounds good. All right. What I do is I have a multi-time frame analysis. So I have a 60-minute chart over here on the left, a daily in the center, and a weekly on the far right-hand side. I assume you can see everything okay. Long-term, obviously, is the weekly chart. Intermediate is the daily, and then the 60-minute is the short-term for the momentum. So we have a couple indicators here you may not be familiar with. One is called the OWL. This is a measure of momentum. It's a histogram. Our second indicator is what we call the PTF. And this is, I'll show you how this works in just a minute. And then finally, we have the TLM down at the bottom here. So we also have some trend lines being drawn on the chart as well automatically by some of our software too. So what we do is we take a look first at the overall trend, and we can do that both on the daily and also on the weekly chart. And if you look on the daily chart and just go back really to 2016, you can see we've been in a nice uptrend on Apple for quite some time. We've got a little bit of bearish divergence building here, okay, in the daily chart. But on the weekly chart, we really do not have any bearish divergence. And we're going to open these charts up in just a minute to show you a little better look here. And if we come over here, we can certainly see the extent of the weekly chart on Apple. Now notice here, this is now the highest histogram. So we think we're still in a major wave 3 to the upside on Apple. But you know, after wave 3, we do have a wave 4 correction. And then after that, we have more highs. So again, as you can see, it's been a trend that's been around a long time. Our system has a stop down on this chart, on this time frame right about here. All right, but not many people really trade the weekly. So let's go ahead and roll over to the daily chart. And we can see a couple things here. One is I would not take a new trade here simply because of the bearish divergence and the length of time that this has been on the upside. The other thing too, I'm taking a look at the 60-minute here. We have a red PTF. This has a 75% accuracy rate. And basically when it is red, you find the lowest price in that red area. And there's a 75% probability the market's going to head lower. So we're still in what appears to be a short-term correction on the 60. So I certainly wouldn't want to go long here, even if I thought there was much more room to the upside. I'd probably hold off a little bit until this either turns yellow, which is neutral, or green on the 60. But again, I don't think really, unless I'm a really short-term trader, I don't think I would be going long on this for a position trade because I'd rather get in after we get a correction and then look for a better time to get in. Okay, that's it.
Okay, thanks, Bennett. So for you, no trade on Apple right now.
No trade.
Okay. All right, we were BCD. So Corey, what do you think about Apple?
All right, I agree with Bennett. And starting with a similar logic in terms, you see the chart screen, is it showing?
Yeah, we got it.
Okay, perfect. Yep. So looking at the same thing, just multi-time frame, the key level support is 156. The caution point is that we are rallying up away from your weekly moving average. So like I mentioned in terms of momentum and volume confirming those new highs, we want to buy on those pullbacks. So that pullback on the weekly chart has been missed. That was essentially this area. So we're swinging higher. We are in a sideways trading range on your hourly chart. Missed a good little very, very short-term trade in terms of a little bounce up off your support level hourly. And let's take a look now at my favorite, the daily chart. So for Apple, we're looking at, again, 156 is your sideways support pivot. Also the rising 20-day moving average. Not a whole lot of kind of gumption or movement to push this higher. To get some more momentum, get some more volume. Bullish up until proven otherwise, but I'm not expecting a whole lot given that it is so far away from the weekly moving average. It is, again, trading range on this frame. If you really, really want to do something short, if you're under 155, that probably plays us back to your prior pivot at 147. But again, neutral, range neutral, bullish until proven otherwise with respect to these key levels. I'd really keep my eye on 156 per share.
Okay. So is there a trade for you that you like this moment, or are you saying really no trade right now? It's conditional.
Well, the trade was missed. I didn't catch it as soon as I wanted to, but it's a pullback. The same thing I do, pullback to these rising moving averages. So that trade is already triggered. So it's a push away from. And I frame things in terms of movement toward and away from critical levels. So right now we're playing up away from 156, probably up to about 162. It's going to continue this sideways trading range in Apple here. But if you're not in it already, that particular trade has been missed. It triggered really yesterday.
Okay. Okay. So really, for Dave's record, no trade right now.
Correct. Correct. Sideways trading range. Let it break out of this range first.
Okay. All right, Dave. Apple. What do you think?
Is it to me?
Yeah.
Oh, okay, cool. It was no shocker when I saw Apple at the top of the list. I like to seek out more inefficient stocks that have the potential to make large moves. And I'll just give you a quick example, not to talk about my position, but I have a position at AKCA, and as you can see, it's gone up considerably over the last few weeks. It's 80-something% in a few weeks. And that's a type of inefficient moves that are possible. Now, Apple does kind of break the mold. It's efficient in that it's super high volume and a lot of people trade it, but it still has obviously gone considerably higher. Now, with that said, you could see in recent times it broke out, but it really didn't get much past this prior peak in here. So for me to take a trade in Apple, it would actually have to break out the new highs and trend, and then I would look to play pullbacks along the way. Now, notice that the volatility is only 23. This is historical volatility. It is just a measurement of beta, so to speak. And if you take a look at something like Kim, which I showed as my example earlier, you can see that it's twice as volatile as Apple, and it's made a much more substantial move. So my goal is to find stocks that look like this, obviously way back here before they take off. If you could find a broker, by the way, to let you trade off the left side of the chart, please let me know. But but that's the ultimate goal. Find something that's a little bit more efficient. I'm sorry, inefficient. Everything isn't priced in. And I do have some free reports on my website. I make you walk through the gift store first. And they're down at the bottom of my store, but they are free. And I explain a lot of these concepts, such as efficiency. There was an article I did for Traders Magazine over in Europe, and it explains the concept of efficiency. So no trade in Apple.
Okay, thanks. And we are getting some really different perspectives. This is awesome. Okay, so I should be projecting my Apple chart. This is a daily time frame, and you can see I've got similar indicators that Bennett had. I got the OWL, got the PTF, but I got the pyramid trading points, but I've also got the Ichimoku cloud, and I found that to be really helpful. So I agree that there's bearish divergence on this daily chart. I mean, it's been in a run for a long time. It's an amazing run. I hate to get long on a mature trend because you just don't know when it's going to turn. Good pullback early in the summer. It broke down through the cloud, went down to put new highs. But as Bennett mentioned, we got bearish divergence here. So these up moves in this price oscillator are getting smaller. The down moves are getting bigger. So it looks like it could be setting up for potentially a correction. And on this chart, on this time frame, just a normal correction to an ongoing trend before it heads back up would take us down into this range of Fibonacci retracement between 135 and 118. So if we can break, I want to see it put in a lower low, lower high, and break down through that Ichimoku cloud, so that price would be about 148. If we can penetrate that, then we might have some profit down into this retracement zone, but we're nowhere close to that. So for me, no trade yet until we can get, again, that break and a clear corrective trend beginning. So it sounds like 0 for 4 on Apple. Nobody's got a trade there. So let's move on around the panel here, and we're going to go to SPY now. So the S&P 500 ETF, and we'll go to the top of the order there, Bennett. And what do you think of SPY?
Okay. Well, again, you're looking at a mature trend, very similar to Apple. The only difference is it looks like this is starting to roll over a little bit more for sure on the daily chart than it did on Apple at this point. But if you notice here, again, Dean, bearish divergence here, no trade for me on Apple to the long side. If anything, maybe a short trade. We'd have to do the fib numbers to see what kind of short trade would be possible. If you look on the weekly chart here, we're still in a wave 3. I'm going to open these up again just because it's hard to see the smaller charts. And if you can see here now, this is a trend that's been in place for a long time. But what's interesting on the daily chart, we see this on the Dow Jones as well, is we don't have bearish divergence in the owl. The owl's the highest right now, which is indicating a wave 3. So when we look at the daily chart, we're actually looking at the waves inside the waves on a weekly chart, and we're seeing bearish divergence on that. So really in a rollover here. So it looks to us like, or it looks to me rather here, like with the bearish divergence here, you certainly don't want to go long. In fact, you know, if you bring your fibs in here, you're talking about a fairly significant correction, probably somewhere, possibly at this point. Let's just take a look here, somewhere maybe from right around here to here, okay, correcting down to 222 to 206. And then after it reaches this particular level here, you should see some more buying coming in. Now, with that said, one thing I will say here is that before I would go ahead and say that's going to happen, we would want to clear this support area right here. So it's very possible we could get one more jump up. But if it breaks this support area here, that's not a good sign. We have a bearish signal generated by the ART system here. So, and we have bearish momentum, nothing green down here. So this is definitely not one you would want to go long on for sure. That's
All right. Yeah, thanks, Bennett. I was watching, there's live questions on YouTube, and I was paying attention to that. And so somebody typed in a question. I think it was, who was it? It was Joe. Joe said, "Hey, if we own it, what should we do?" So let's include
That's a
that in
good
the
question.
comments.
Yeah, that's a really good. You want me to tackle that one?
Yeah. So if you owned the SPY, what would you do, Bennett?
Well, okay. If I own this for right now, I personally, as you can see, here's a Dean, a pyramid trading point here, which you're familiar with. So we would have been out of this long trade here. Now, if you're a real long-term trader and you want to stay in this for quite some time, well, then you can put your stop way under here. But as short-term traders, we're probably not going to do that because that's giving a lot of profit back. So if you wanted to take the juice out of this trend here, you would be stopped out already. Now, if it does go a little higher, I'm going to tell you, we've been analyzing the Dow. It's probably not going to go that much higher. So you wouldn't be missing out on a whole heck of a lot. It's very risky in this area here at this point for a long trade at all. Okay.
I agree. You'll hear that from me too, but thanks. Okay, Corey.
Okay, sure.
I'll echo the same. Little differences. This is a kind of a bugaboo because this is why I go back to Dave's logic and Charles Dow and Linda Raschke and this trend continuity principle, which is the foundation of really what I do. You'll notice what I'm showing here is the daily chart, and each of these little green spots effectively are bear traps. Bear traps in that they broke down beneath the rising 50-day moving average, and that's typically a sell short spot or take stops or liquidate your positions. But 1, 2, 3, 4, now 5 times we've had that sort of bugaboo, just here you go, get short, and then poof, magically going back up. And each time it's happened, it's been really relatively a strong run. So this at the moment is a type of, I would argue, weak, but nonetheless, bull flag formation. And this is as an intraday trader, I was able to catch with my analysis, and then the trades I do more intraday on the SP, on the ES, not the SPY. We were going into today's session bullish because of this trap scenario situation, repetitive and called repeat pattern behavior, and 2 reversal candles. And on the ES, it was a different level, but nonetheless, so we did get this push back up. The target was right here. So the target has been achieved. It's essentially the falling trend line, but more importantly to me, the falling moving average. So what do you do if you're in this? If you're bullish and holding long, today was a good little graces day, but don't jump out just yet. Wait for the market to see if it can break above this 246 level. If so, that's a falling trend line, falling moving average, and that probably does retest out the high. Otherwise, let yourself be neutral going into this, because as they mentioned, and then as Dino mentioned too, I'm showing divergences both in my momentum oscillator, which is different than Bennett's, and in volume. So I want to use the word distribution, given that these little spike ups in volume are red cell volume. So that's a caution. And one quick mention on the weekly chart, another kind of good buy. You did have the price pull back to its weekly moving average. So that was another kind of instance or probability for a bounce play. But my goodness, this thing is getting overbought, divergent, and I would argue distributive really quickly. So you may have one more little push in the gas tank there, but this thing's not looking as good as it used to look. But each time it looks bad, the market just goes up to new highs. So that foundational trend is what keeps me going with this one, essentially. All
right. Thanks, Corey. Dave.
Okay. Spiders are another one of those markets that are very efficient. Everybody and their brother is trying to trade them. And then notice you have an HV of 8 right now in the spider. So it's not a market that I'm very excited about trading, but obviously in my analysis, I do spend a lot of time looking at the indices to see what's going on. And Dean, do you think we'll have time to get to the IWM? Because if not, I'll show that chart in a second.
If you want to contrast it and show it real quick here.
Yeah, I'll show. Okay, I'll do that then. Anyway, as far as the S&P 500, if you take a look at it, we recently broke down a little bit in here. And as Corey pointed out, we went down and tagged that 50-day moving average. Other than the occasional moving average, I don't use any indicators whatsoever. I'm what's known as pretty much a priced purist. Moving averages don't indicate anything or any other indicator. They simply illustrate what's already there. And obviously, the upward slope and daylight is a concept I like to look at too. The lows are greater than the moving average. And then those tests or bear traps, as Corey called them, is when you didn't have, you no longer had the upside daylight. But so far, every time the spiders have hit it over the last year or so, they have survived. And looks like so far it has survived in here. What has me concerned, a couple of things. Notice that these are my bow tie moving averages. Usually when you get a bow tie signal, which is also in the free reports on my website, which is simply 3 moving averages crossing over a very short period of time, 3 to 4 periods. And it works in all periods. If you get a bow tie in a weekly, every bear market for the last 30 years has been signaled by that, which is a little scary. But we don't have to worry about that just yet. I won't go into weeklies because Corey pointed out, as he said, they're in an uptrend. But that would be something good to keep an eye on. Somebody mentioned where should they stay long or what should they do? And let's just say on your next trade, before you go into it, you should always know where you're going to get out if you're wrong. So in other words, where's your stop and what was your plan? I don't want to pick on you for this particular trade, but if you've been doing this for a while, you really need to have a plan in place. You can't just wing it. So that's what I always tell people. They say, well, what should I do? It's like, well, where's your stop? And if they can't tell me that they have one, then I don't want to pick on you if you're just getting started, but you probably should be trading without a plan because eventually you're going to get in a lot of trouble. Now, let me just show you real quick, just in case we don't get to it. We have a bow tie down in the Russell 2000, and the Russell 2000 has gone sideways forever. We did make new highs here. We bow tied down. We triggered a couple days ago, and now we're getting a little bit of a bounce in here. So I'm somewhat bearish still. A few big up days will make all the difference in the world. I'm a day-to-day kind of guy. But this does concern me. If the Russell drops below 135, you got a lot of overhead supply. And just a couple of more thoughts real quick. In my market analysis, while looking, I consider it being on a treasure hunt, I look at around 2,000 stocks every night trying to find an opportunity. And then I also look at 250 sectors or so, some ETFs, and then I look at, obviously, the indices. And internally, it's fairly ugly. And if you have time, take a look at your sectors. And a lot of sectors or looking a little ugly in here. Now, again, a few big updates would make all the difference in the world. But right now, I really think, since we're talking about the overall market, you need to do three things. One, honor your stop. Make sure you have one. Number two, be very selective. And it's okay to sit on your hands. And number three, don't rush out and put on any shorts just yet, but start keeping an eye out for them just in case. And I'm not a huge fan of the short side, but I do play both sides of the market. And the reason I like the short side, or I play both sides of the market, I should say, is because it does help me to see both sides of the market. You're not going to get rich on the short side because the retrace rallies are really tough. As a trend follower, at least, it's very hard to hold on to positions longer term like I like to do. But it does keep you in the game. You can make money in a bear market, and it also helps you to see both sides of the market. My friends who are running lots and lots of money and they're long only oriented because of the charter or whatever the case may be, they tend to always be a little glass half full versus glass half empty. And so that's one reason that I would encourage you in time, not if you're just starting trading, then take your time, give yourself a couple years, but then within a few years of trading, I would encourage you to learn how to play both sides of the market. Okay, I'm done.
All right, thanks, Dave. And you know, good teaching slipped in there with your analysis. Good points all. I like them.
Thank you.
Okay. So I'm showing the SPY here on a daily chart, and there's something new going on here on the chart. Now there is bearish divergence. We're losing momentum. I think 3 of us have pointed that out now. And again, I use the Ichimoku cloud. It projects potential support and resistance. And when price breaks down through the Ichimoku cloud, it can quite often signal a change in trend coming. And you know, the last time the SPY broke through the Ichimoku cloud was right before the election. And of course, the election, we had some new information enter the market, and it's run up, you know, pretty significantly since then. It's come down into the cloud, but found support every single time. This is the deepest it's gone. The wick on yesterday's price bar here actually almost touched the bottom. So we got a little Dow thing, a little lower low, lower high, and Bennett's indicator put up a pyramid there. Now we got a new low. We're pulling up. Really key decision point, I think. If we go up and put in, you know, up above this little minor high, then it's probably going to keep going. But if we go put in a new low, it's going to be breaking below the cloud. We've already got negative momentum on the oscillator. That could be a signal of something new happening. So I'm watching really close for a potential short on the S&P 500 if we can break down through this last low, which is sitting at about what? On the SPY, it's sitting here, you know, let's call it 241. You know, if we get down there to 241, 240 with a good solid close with some momentum, there might be a nice short play coming. But that's conditional. That hasn't happened yet. So I actually like to see charts like this where I'm waiting for something to happen. I put it on a watch list. I put an alert on it, and then when the condition I'm looking for is met, and I don't have to go scan it. It's just play it, and I go take the trade. So I don't like it yet. If I were long, I would be out. I would go, you know, at open tomorrow, I'd close my position. I don't want to be long this. It may go up a little bit more, but I think the probability for a bigger move down is higher, and I don't want to be long the SPY. And I would be looking for a short again at about, you know, 241, 240, a new low, good solid close down there. That's my take on the SPY. Okay. Next up here, we're going to go around is Amazon. And so Bennett, see what you think about Jeff Bezos' operation there, AMZN.
Okay, well, he's done pretty well so far, hasn't he? It's again, this is a trend that's been going on. Let's just quickly take a look at the weekly chart here. I mean, look at that, huge. Notice too, back in here, when it was fairly flat in this area here. Now, this is a weekly chart, granted, but this is going all the way back to 2004, 5, 6. Check out how long it was channeling. Now, Dean, I know you're like me. If this was a daily chart, we'd be all over this on a short-term or a position trade to go long when it breaks out. Now you're sitting way at the top, all right? We've got a 3, all right? And you can see when 3 finally does end, it's going to be a pretty big drop, okay, to 4. And then, again, you'll get eventually a 5 taking it to new highs. So you do have a little bearish divergence building inside 3 here. You do not have a red owl yet. So it's really too early to call whether 3 is over on this time frame. So let's go down and take a look at the daily. And notice the daily has rolled over quite a bit more in terms of an actual possible short position for a shorter term trade. Now I put a fib area here where we may have a high probability area target zone, okay, for a correction here. It's also possible if it blows through this and goes down deeper, then that may mean that wave 5 is over on this, and this is a solid wave 5. But right now it's just too early to tell, but it is certainly conceivable we could go down into this target range and see more movement up if 5 continues. So we'll take a look at that. One thing I want to take a look at too is a 60-minute chart. Notice here we have bullish divergence on the owl, but we have a red colored PTF. So no long position for me until that PTF either turns yellow or green. But I have to be honest, I wouldn't take a long position here at all, even if it did turn yellow, because I really think at this particular point we're going to see more lows, possibly getting into this target zone at the very least right now. So I'm kind of bearish short term on Amazon, so no long trade for me.
Okay, very good. Yeah, and our analysis is, I'm looking at a daily chart too, and I guess I'll wait my turn and get into it there. But Corey, what do you think of the 1,000-pound gorilla or the $1,000 gorilla?
I caught a good short trade.
$1,000 gorilla.
$1,000. Well, better dollars than pounds, I guess, right? Unless you're British. But I caught a good trade going back down. Again, I'm more intraday, very, very, very short-term swing trade. I'll discuss it in a moment. But Bennett's right. Strong uptrend, higher highs, higher lows, rising averages. Not to be repetitive, but Amazon's back at its weekly moving average. That's good. That's support so far. It is at a price pivot. It's really a polarity zone at just about $9.50 per share. So that was your down move. You've had multiple bullish retracements up away from that. Just like Apple, there was a very recent trade that pushed away from this level. So again, I trade in terms of levels, price moving toward or away from them. The trade that I called in the membership and the little swing trade section was this little short into this pocket of resistance, and I'll show that. You had really declining bullish volume on a push up, little reversal candle. That trigger was as it moved away from this little, basically broke the low, and you're targeting nothing more than your support level. That was a successful 2 to 3 day trade. That was the most recent one that I took with Amazon. But now it's pushing back up away from this 950. And I wanted to highlight how these volume signals work. So again, a higher high, momentum pops to a new high, volume comes in, that's bullish. You want to be a pullback buyer. And that was successful up until these negative divergences and cluster of sell or distribution volume, particularly as it went up just above this 1,050 level. Multiple updates look really bullish on the surface, but beneath it, momentum was not confirming, and clearly volume was not there. And that set up this crush down back to your pivot. So I'll just be a short-term forecaster at this point. Bullish as it pushes up away from 950, nothing special, trading back to at least 980, 990, probably 1,000 at the most. But if you start to falter, if the market does turn, Amazon probably turns with it. Bennett's right, your pivot points beneath, I'm not going to forecast or anticipate, but if and when Amazon does break 950, you probably do play, I'll show you an overlap, to about 900, because that's your 50-week moving average, your lower Bollinger, and it's your 200-day simple average. So a bullish until proven otherwise, trading range at the moment, just like Apple. Breakdown sell short trade for aggressive traders only beneath about 945, down to 900.
All right. We are going to be a little bit similar here. Okay, but we'll go in order. Dave, what do you think about Amazon here?
Okay, I'm a trend guy, and usually, like the Kemet I showed earlier, I like to play mostly trend resumption patterns, and that means that we have a long established trend and a pullback. Now, I will trade transitional patterns when a market appears to be turning, and transitional patterns, you're a bit of a pioneer, and like the early pioneers, you either get the gold or you get arrows in your back. So one transitional pattern, which I mentioned earlier, was the signal in the IWM. And if you look at Amazon, we now have that pattern set up. You can see the bow ties came together and spread out. This is a 10 simple, 20 exponential, 30 exponential. Again, you can get it all on my website. There's a button on the home page you can click on. I'll show you at the end of the show. And you can get to all the free reports and everything else. And that would have triggered a few days ago. And we're getting a little throwback up or something, whatever you want to call it, a little rally with the overall market. Like Corey pointed out, it probably will have a high beta or low beta. I forget how they call it with data, but it will probably trade in tandem quite a bit with the overall market. But I think it's in trouble. I think it's more of a short than a long. If you wanted to short it, I think 950. I see no reason to disagree with Corey's target down there. And just for fun, I was playing with my charts while you guys were talking, multiprocessing, and I noticed that you had a bow tie here, and you had a pretty substantial drop, far enough to get a decent profit out of it. You had another bow tie here, then you had another substantial drop. Now, it did resume the longer-term trend. So, again, I think that, as I said earlier, it would certainly work for the short term. Certainly. Just say certainly. Let me rewind that. There's the higher probability of a short-term trade. Longer term obviously remains a question mark, but you get in for the short term and you stick around for the longer term. So I'd say 900 would probably be a good target there. Trail your stop down at least to break even, and then if it breaks 900, just enjoy the ride lower. But as you can see in previous bow ties, there were some fantastic trades, but the market turned around and went back up longer term. So bearish on Amazon, a trigger on that would be 950. Give it quite a bit of run, maybe somewhere up in here to 1,025, and that area would prove that you're wrong. Just get out the way and then take another stab at it some other day. As we used to say back in the hedge fund days, he who fights and runs away lives to fight another day. So again, want to beat the dead horse on money management. Make sure you have a stop in place on every trade.
All right, and I agree with that. We'll keep echoing that. All right, so I got my Amazon daily chart up here, and I actually like it short right now. It's not the perfect setup. It's not the highest probability trade, but I've got a retracement point. I think I'm anchoring it at the same point that Bennett did here, with a price target zone down between 850 and 705, probably at the higher end. I say it's not the highest probability trade because it's done this a couple times before, and it could be a fake out. But it's a beautiful, strong trend. It will correct at some point. There's a very high probability of that. Is it now? Maybe, right? We've got nice downward movement. We got lower lows, lower highs, lower lows. We got bearish divergence. We got price down below the Ichimoku cloud. So I would be willing to take this at just a new low, one tick below whatever yesterday's price bar was. Looks like about 950. So we're all kind of lined up on that number. I would have a pretty tight stop on it because if it's going to go, it's going to go. So my stop would be above this last high at about 994, and I would use for my calculation a target price right inside this Fibonacci retracement zone at the top end, be conservative, and that's about 847 would be my target. So entry 950, stop up at 994, target at 847, and since it's not the highest probability trade, I would go in with a half size position. Normally I use 2% of my account. I take the entry minus the stop, divide that into my account size, and that's how much I'm a tolerable loss, and that determines how many shares to trade with. I would take a half size position, and then if it started heading down, I would scale in profit after I move my stop. That way the risk is still controlled. We're never going to risk more than 2% of the account on it, but I would take a half size, and if it starts going our way, scale in pretty quick. Once we get in profit, once we trail our stop to a new resistance area, and try and let this thing run down into the thing. And $1,000 stock or $950 stock, I would definitely be just buying puts on this. I'll be looking at puts out in December or January and just trying to find a high delta put to go take this trade with. That'd be my approach to it. But I like it long tomorrow or short tomorrow if it gets down to a new low of about 950. All right. So I don't think we disagreed radically on that one. We got two more from the list, and hope we get a little bit of time to do a few freeform ones there as well. But let's take a look at Alibaba. That's the next one.
Okay.
The Yahoo of China, right?
Yes. Yeah. Boy, and boy, has it done well. Okay. Can you see what you can see my chart right now, right?
Yeah.
Okay, good. All right. So again, I mean, this is unusual. And Dean, I know you use these indicators too. So what's unusual is, check this out: green, green, and green on the PTF, all time frames. Green, green, and green. So everything is pointing to higher highs. The problem with this is going in now is that if you go in using a daily time frame, you'd have to put your stop down here. And you're getting in late again on the trend, which is one of my issues that I don't like to do. You also have bearish divergence building here. You have no bearish divergence on the weekly chart. That's looking real good. There's no question you're going to get higher highs. The problem is, if this is a wave 3, it will eventually give way to wave 4. And when you get in late, all right, there's a chance that you're getting in so late that you catch the tail end of wave 3, it sells off, and you don't make much money or any money sometimes getting in too late. So that's the problem with the trade here. Though, if you're in the trade now, you stay with it because there's no reason to exit the trade. You can get a little bit higher high. How much higher? Well, probably what we would have to do is go to the 60-minute chart here. And as you can see, we're in a 3 here. So we wait for the owl to turn red. That's going to signal a wave 4. Draw in your fib retracements for the wave 4 target zone. And then after that, we can draw in our fib extensions to get the end of wave 5, which will probably be the end of wave 3 on the daily. So that would be one way of getting some type of target range for the top of wave 3. So if I was going to trade this to the long side at all, I would probably use the 60-minute chart and make it a shorter term trade. I probably at this point would wait for wave 4 on the 60-minute chart before entering a long trade, and it wouldn't be a very long-term position trade. It would be probably a fairly short, maybe a couple weeks trade at that. So it's very bullish on all time frames. There's no question about it. The problem is getting in late on the trend, even though there are some more highs. These indicators at the bottom are not going to tell you how much higher it's definitely going to go, and therein lies the problem. So I would probably not enter a long trade at this point, but I would consider a long trade on the 60-minute chart once we get down to this wave 4 area, but we're not there yet. So I would not be long on this chart as a new trade. If I was in it already, for example, a great entry would have been down here when all these indicators turn green. Then you're home free. I mean, you're in a trade that you just want to stay with it until the momentum starts to turn bearish.
All right, thanks, Bennett. Corey, what do you think about Alibaba Group?
I'm reminded by a quote by the great, Jeff Probst of Survivor. When that team loses, they come back, especially a luxury challenge, comes back and says, yeah, I got nothing for you. Go back to your tribe. So this is what I feel about Alibaba. Not because it's bullish. It's because there, as Bennett said, there is not a spot or a point to get long. That's okay. Nothing's wrong with that. But my methodology is identify a trend. My core belief is that which is strong tends to get stronger. Strong stocks get stronger. Great example, probably one of the best examples we can look at right now. Does that mean you just walk up and trade it? No. So Bennett's exactly correct. One more point I would like to make about Alibaba here, put my little teacher hat on. Does anybody think that this looks familiar? So we just think about the audience. Think about, what does this look like? What have we talked about? What pattern does this maybe look at? And if you're looking at this, if I sort of played devil's advocate and say, oh, it's got a negative divergence, making a range pattern, there's a little trap scenario, probably short it under here, But what happened next was a breakout. Does that look like Apple? So as it loads, is that not Apple? Is that not what's going on with that position? I'm not calling for a surge up in Apple, certainly not. But as technicians, as traders, that's what we draw our attention to, is pattern repeats, things that are similar. If this particular chart pattern, a flag, a breakout, a retest, whatever, a rectangle, what's likely to happen next? So I would really draw an analog, at least in terms of this little sideways reaction to where Alibaba was just a few weeks ago. Strong bullish, probably higher, but once again, we don't, as younger Corey, 10 years ago, Corey would say, I'm going to get long because it's going to go up forever. 10 year later, adult Corey says, oh my God, this is crazy. Let's wait for a pullback. So I'm going to go back to Jeff Probst. Right now, I got nothing for you on this one.
Okay. Amen. Amen. All right, Dave, you got anything for us on Baba, or you can just make it short and say no trade for me?
I'll keep it really short. Years ago, I got called a trend following moron because I used to draw big blue arrows on the chart. So now they're cyan, but I'm going to draw my big blue arrow. It's in a definite trend. Any trend following moron can see that. For me to get excited about it, it would have to pull back, but I kind of agree with Bennett. It's kind of long in the tooth and late in the trend. And even though I do like things that have been trending for a while, I just prefer getting in not when they're so extended like this. Maybe some sort of knockout type of move. Notice we had a little knockout move back here. That was kind of an interesting point for this stock. So maybe it had a big knockout move possibly, but no trade for now. But if you had to, obviously so far it's headed higher. So it's in an uptrend.
Okay. So my chart's showing here on Alibaba, and yeah, for me, no trade, way too late. But I do have to point out this was fun. So we took this, here's here's Elliott wave. This initially looked like wave 3 back here. This was the big impulsive move, right? When the chart's here, there was the big impulsive move, right? In this, in the last year. There's the big impulsive move. It had a perfect correction down into a Fibonacci retracement zone. So when that started breaking, just like I'm talking about with high, higher, low, new high, breaking above the cloud, we took that entry at 106 cents, right? And rode it up to that, and we just trailed our stop right up and right up to that knockout point that Dave was talking about. So we got stopped out at 1824. So I'll take 18% on that. That was about a 2.5 month trade. Yeah, we missed that big move, but you got to have rules. You got to follow them. You got to have a stop, and you got to get out. And by that time, it was already too late. We were already in the target zone that we had projected in. It's moved. This is now wave 3, and I think, like Bennett said, next move we're expecting at some point is a big correction to this, and that may even be tradable, but it certainly hasn't started yet. So no trade here. The trade for me was back at the start of the year, and it was a pretty nice one. All right, our last of the top 5 is GLD, the gold ETF. We get through that pretty quick, and then we'll take a couple freeform, and we want time for each of the panelists to share their favorite current trade. So let's see if we can move through GLD here pretty quickly. So Bennett, what do you got?
Okay, let me start out here. All right, I'm going to start out on the weekly chart for gold. And on this chart here, we see quite an interesting turn of events here. Okay, so in terms of Elliott wave, we're looking at 3, 4 with a 5 up here. So gold's currently at 122. The target range for wave 5 based off fib extensions are 181 to 232, higher than its previous wave 3. So that's pretty substantial, and it's also pretty counterintuitive. Most people look at that and say, oh my God. But that's where we think it's going to go. The Elliott wave is amazed us before, during the 2000 bubble in the stock market, the Dow. We came out with a forecast of around 7,400, and back in the late 1990s, people just thought that was nuts. So things can happen, and it looks like gold's going to be on an uptrend on the way up to wave 5. So that's kind of what we're looking long term. So then the question is, where do you put your stops? As Dave says, you never want to trade without a stop. You never not want to calculate your trade size either. So good place to put your stop is always try to get in right after wave 4, put it under wave 4. But if you want to go in now, you could put it right under this level here, okay? And we'll take a look also too at the daily chart. And then I'll turn it over to Corey there. And on the daily chart, that would be this level right here. So let's just take a look here real quick, bring up the data window and kind of get an estimate here of where we would take it. So that would be basically the December 2016 low, right around 107 and some change there. So that's where your stop could be. Preferably, if you can afford to do it lower, always do it at the bottom of wave 4. But it looks to us like that might be a pretty good spot to put it in as well, and that should get you up to the target zone. So this is one that I like and long on. Okay, so that's where I stand on that.
All right, and that's long on the gold weekly chart, right, Bennett?
Yeah, but you can use the daily and just put your stop down here. But yeah, the actual Fibonacci extensions are based off the weekly.
Yeah. Okay. Great. All right, Corey, you a gold bug?
My gold bug, no. I'm going to create some controversy here. Well, just what I wanted to say in terms of trend analysis, this is sideways. So Bennett's right that it's forming a reversal pattern, higher high, higher low. But look at where this is weekly. This is a longer term chart. The 20, 50, and 200 week moving averages, sort of the principle Dave is using for it, they're all flat. They're all overlapping. And that just is indicative about how long this market's been flat to neutral. And I would argue we're even forming a compression within this range. So 2, at this point, weekly reversal candles. I'm not obviously bearish gold. I'm not bullish either. But right now, as a short-term trader, I will make a call on this one. We'll be shorting this one with a stop right above these little pivot points. So if that does happen, the Bennett's breakout will be valid. But at the moment, I'm essentially putting a bet or expectation here, dominant thesis, that the market probably just continues this range. That's not bullish or bearish, just stays within this trading range and probably pushes short term down away from it. And that's not asking a lot, down to about just above 118 per share in the GLD. And looking at volume, momentum diverging, reversal candles at that point. And there's your weekly pivot, daily pivot, and short-term hourly divergences. So I would say alternate thesis bullish. And I always say if something should not happen but does happen, it tends to lead to a bigger move in that direction. So it's a lot of stop losses or new initiation of bullish buy orders above these pivots. I think they should be obvious that it's resistance level. So traders probably will react quickly if the market pushes above, in this case, 124. Otherwise, I will be a dominant short-term thesis bear, just trading it within this trading range. Stops above 124, of course.
Okay. Thanks, Corey. Dave.
Okay, let me draw my arrow on the chart, and you can see it's gone sideways for quite a while. Gold is another one of those efficient markets. A lot of players fighting it out, hedgers, speculators, people that actually consume it and use it. So it could be a very choppy market. And even if we did break out of this, we have some resistance up here. So for me to get excited about it, it would have to get, let's say, above 130 or so, and then I play pullbacks along the way. Now, commodities and Forex, efficient markets like that, they can offer some opportunities, but usually it's on the fringes. If you go back in and look at gold, at 2016, we were buyers specifically in the gold stocks because it made a nice longer-term bottom, and we had the bow tie pattern, and we also had a nice thrust from low. It's a pattern I call a first thrust. So for me to trade an efficient market like this, it would have to be on the fringe or at the least in a solid uptrend followed by a pullback. And right now, 125. So it would have to get above 130, and then I play a pullback somewhere along the way.
All right. So we are having some good difference of opinion here. That's awesome. So I'm showing the gold futures, the continuous contract on a daily chart. You know, I like to take all my cues on gold off the futures contracts, and you know, GLD, in my opinion, is just going to follow whatever the futures are doing. This is the actual price of gold, or really, really close to the actual price of gold. So my analysis for gold and for oil, right? If I'm going to do a USO trade, I'm going to go look at the CL contract. If I'm going to do a GLD trade, I'm going to go look at the GC contract. So this is the GC contract, continuous on a daily chart. And we've all noticed this sideways market, right? I think if we break, I agree with Bennett's, no surprise, right? We use a very similar method, but I agree with his weekly chart analysis of potentially a big wave 5 starting. And I think we could see that start. We've come up to this 1307-ish level. I got a purple line there, right? We've come up to that 3 times now, reversed off it. So maybe we'll reverse down and continue down again in the sideways market. If we get a good strong break up through 1307, I think there's a pretty good chance that we've got a bull market beginning in gold, and I'll be trading that. And I like GLD and I like GDX, the gold miner ETF, to trade it with as well. And I love, for a long trade on that, buying the puts on either GLD or GDX. GDX seems to move a little more aggressive, a little more fast, so I actually prefer that. But I think we might be setting up for a bull run here in gold. Got to confirm it with a new high up above 1307. So that's where I'm at with gold. Let's go ahead, before we jump into some of the other pick ideas, let's make sure we have time. And so let's go with each panelist here and give us your favorite trade right now. What do you like? Right? Most of the ones we looked at are in pretty mature trends. They had some ideas, but it doesn't sound like it was any of our, they were any of our favorites. So one that you think that is your favorite, that you like a lot, Bennett, and why don't you lead us off with that?
Okay, thanks. All right, so what I like is lumber liquidators. We've liked it for a long time. We got in early, Dean. As you know, this is a 3 to wave 4 trade. This is our target zone, sitting up at 48.26 to 72.41. And notice we broke the 23.6 fib line, so we're going to move our stop from the bottom of 3 all the way up under this area here. So the key with trading these counter trend trades is they can be very volatile. They can wind back and forth. They can channel. So most people never make it to the target zone because they move their stops up too quickly and too close. So one of the methods that we do is we keep our stop under wave 3 until it breaks the 23.6% fib line here. And the reason we do that is because 15% of the time wave 4s fail, and they only go to that particular area between 23.6 to 38.2. 70% of the time they reach the high probability zone, which is between 38.2 and 61.8. So we always shoot for that zone, that target zone. So as you can see, we got in really early in this area here when we broke above. It was in the around $16, $17, and we're sitting up here now at roughly 35 and some change. And we think it's going higher. We have a green PTF here. We have a tremendous amount of momentum here. We still have a green PTF down here on the weekly. So we don't want to get our stops too close at this point, but we'll watch this momentum, and when it changes, then it'll be time to start scaling out. But we think it's going into the target zone. So I think it's been a real nice trade. If you're thinking about going in it now, this would be one where, again, you're not going to have as much profit potential as if you got in early, and you would have to put your stop under here below that gap, okay? So you want to make sure you're below that. But that's one of our favorites right now.
Okay, nice. Yeah, we took lumber liquidators earlier too, and already out. We had a little bit of volatility, and we were trailing it up pretty tight, but I think we caught a 20-30% move on it in a pretty short time frame.
Yeah, I'll bet.
Yeah,
it's good.
Real nice. Yeah, that was good fun.
Excellent.
Okay, Corey, what do you like? What do you got?
I'll be nice, and I'll put one of the top stocks on the list here. I have a couple of things on my own, but just to kind of get one we didn't cover is Netflix. And again, I try not to be bullish or bearish and frame my trades in terms of departures, usually in the direction of the trend, if at all possible. Netflix is right in the middle of a good little move here. So it is forming reversal candles, Fibonacci, and a little prior price high support. I'm going to call it neutral / bullish pivot at this spot. Stops beneath your, really, what is that, 165, 164. It's going to be your key pivot. And another reason I like that is that it is near the weekly average. And this is, in terms of my other favorite trades, is a rising daily chart, pull back to a support level like Netflix, but you drop down to the 60-minute chart and you see a persistent positive momentum divergence. That, for me, is about as good as it gets. Does not guarantee a successful outcome, of course, but it does allow for a relatively tight stop, and you're going to put some more things in favor: higher frame uptrend, daily chart support, daily chart reversal candles, lower frame positive divergences. So a couple of other names are like that too. Just that's the one I would recommend, but Google is not that much different than our support play. So same thing. You're seeing a lot of plays set up, and that's fine. That the markets are correlated at these weekly pivots, daily pivots. And so as a try to be, again, neutral trader, again, I focus most of my things intraday, but as a swing, in my swing account, this is what I want to see, is a pivot away from a critical support, ideally on divergences, tight relative stop, and playing toward nothing more than the prior high. So I'd look at Netflix for that pivot play.
Okay, nice. Dave Landry, what do you got?
All right, not a whole lot. I haven't seen a whole lot of setups as of late. We've got one new setup going in tomorrow, and we've gone weeks on and off without any setups whatsoever. And that's a hard thing to do, is learn how to be patient. Now, we are long this stock now. We are underwater in it, so I'm not, just want to let you know, I'm not just talking my position, but I still think it has potential. I've done a lot of research in IPOs. I actually did a course on IPOs. And one thing that I found is when they make new closing highs, a lot of time they take off. In fact, a lot of times all you have to do, believe it or not, is buy them on new closing highs. And it's kind of shocking, but we've been in a bull market for IPOs for several years now, and that does tend to help. Everything works better with trend, and everything works better in a bull market. But I wouldn't get in this one as a new position unless it took out $3 a share, this little pivot in here. But again, a lot of times IPOs take off, have a correction, and then when they're making that new closing high after 1 week's worth of trading, it can make for a really good longer term trade. And they either fly or they die. And once they start making new highs like that, closing highs, everyone who owns it is happy, and they tend to sit on their shares a little bit just to see what's going to happen. And there's some other things that I don't have enough time to get into with IPOs, but obviously there is some manipulation that happens in these markets. I know, shocking. And as long as they're making new highs, they tend to be able to buoy it along. So that would be my trade, but only above $30 a share.
Okay, I think I missed the symbol. What's your symbol on this?
Oh, I'm sorry, RDFN, Redfin Corp.
Okay, very cool. Yeah, and I don't trade IPOs at all. So it's curious. It's interesting that you have a method, and it's not like a very methodical way of approaching it. But I avoid them. I want plenty of data on my chart and history. But that's so it's pretty interesting, pretty cool.
Yeah, well, that's you're right. You don't have the data, so you don't have the confirmation. But then that could actually be a good thing because you don't have all the bad memories, and that's why the new highs, there's no resistance, and that's kind of the theory there. Plus, everybody who is looking to get off the hook, sweat equity people or people, VC, et cetera, people who bought before it became public, they're happy too. So as long as they're all happy, they tend to keep on going. But I'll be happy to share all my research with you. Just let me know, Dean, and I'll get you set up on that.
That'd be awesome. Yeah.
Thank
Okay,
you.
I'm showing my favorite trade right now, and this is Vale, VALE. This is a Brazilian mining concern. And, I use Elliot wave, and I've said wave 3 is painfully easy to spot on a chart. It's the biggest, most dramatic move. And when you see a big dramatic move up and then you see a correction, that's good news too, because we've had an impulsive move, we had a correction to it. Now we're looking for a continuation, a wave 5. And then we put a Fibonacci retracement on there, we measure it. It retraced perfectly between these two blue lines, 38.2 to 61.8. Perfect retracement. So we got into this when wave 5 was confirmed to be getting going. Higher highs, higher lows, new highs, broke above the cloud, positive momentum. So we got into this trade at this blue line, this cyan colored line at 903. We had our initial stop at 762, and then we did a cool little math trick. once we've trailed our stop up to the new support level, so my new stop's at 923 above my entry, and there's still a lot of room. The target is up here between 1223 and 1523. So we added to the position, and we can do that. We can add in. Once we're in profit, once we've moved our stop, we can add to a position without increasing risk, but we can increase the profit potential on it. So I think that's a pretty slick trade management rule. You know, I never double down into a trade. I hear traders that do that. You know, goes against them. They add to the position to lower their overall cost basis. The only time I'll ever double down is when the dealer's showing 6 and I got 11. Other than that, I'm going to wait and control risk. And so this is a slick way to do it. So we've already scaled into this position. We're in nice profit. Even if it stops out now, we got a winning trade, a small winner, and we think it's heading up there into the target zone. So VALE trades at monstrous volume. You know, 22 million shares today. It's got a beautiful option market on it. I'm trading it with the what do we got? The December $7 call is what I'm trading that with, and that's probably still a good contract. So VALE, I'm liking that one. I'll bet Bennett, if that wasn't on your radar yet, I'll bet you made a note of that one because you know that pattern there, right?
You know me well. Yeah, that's a good
All
one.
right.
You're gonna do well on that one.
Yeah, and you probably agree with the scale in move on that one too at that point too, right?
That's good. Yeah, no,
yeah,
that's a good one. Looks good.
Yeah. So why don't we go ahead now? Let's catch one more on the live chat coming in. One guy asked if we could take a look at GS at Goldman Sachs. So I'll lead off and let you guys have a chance to bring that up and get your thoughts together. But let me project Goldman Sachs here. And what we got on GS for me is big. You know, wave 3 is really easy to spot. It's a big move. Now we're looking at a correction. It started, didn't make it into the Fibonacci retracement zone, and now it's going totally sideways. So there's no trade for me on GS because even if it does make it to the target zone, not enough profit, right? There's just not enough profit. And I would have to see real evidence of the next move up to get excited about a long on this. And it would have to take out this high and, you know, because we got bearish divergence down here. So there's no trade for me. It's sideways. It's you know, too late to go long and too late to go short. There's not enough profit for me on Goldman Sachs. So what do you think? We'll go back. What do you think of GS?
Okay, can you hear me?
Yeah.
Okay, great. All right. Yeah, I agree, Dean. Notice I have it drawn up here with the fib retracements. So if this is a 3, then this would be the target zone for 4. We've already hit it. And as you can see, it's kind of going sideways, not moving. Probably wave 5 out there someplace. So if anything, I would probably be getting ready for a long trade. But, you know, the momentum is currently red here. So I would wait. This could be a possible wave 4 bottom here. Okay, so it may be okay, but I would probably wait for this to break this area here, this little resistance area here. And then if you go along there, let me just quickly draw the fib extensions. So we'll go here, 1, 2, 3. If that is the wave 4 bottom, then we're looking probably at a target zone somewhere between 272 and 311 for a wave 5. So that's
all right.
You know, that's kind of what the way I see it now. So, you know, I think probably short trade, no, since we hit the target zone. Long trade, look for it, but it's too soon.
Yeah, and I think it could meander back down farther into 4, but not enough.
It could. Absolutely
not
right.
enough to be exciting. Not enough to be exciting.
Exactly. There's not, as you said it already, there's not enough profit to the short side anymore. But yes, it could dip back into the target zone for sure. And if that's the case, we'll have to redraw our fib extensions if it goes lower than what we think is wave 4.
Yeah. All right. Did you get enough time, Corey, to get get an opinion on Goldman Sachs?
I did. I watched Goldman. I agree with Bennett. I would say that the trade has passed, at least in terms of a pullback trade. I just take a look at this. Obviously, a rising chart, rising averages, extreme bullish move. That was into 2017. New momentum high, volume surge, and we've had a peel back in volume. So that's typically bullish on the bigger picture. That sell volume is not picking up. So we're still going to be bullish until proven otherwise. Your best spot to trade it, it didn't give a great outcome. Your best spot was this dual pullback to 215, which is really your rising 50 week and your prior high. And from that, kind of show why that was a good trade. That was in real time. It sure looked nasty on the daily chart, but that's what a pullback is. Pullback to this 215 zone, rising 200-day simple, lengthy positive momentum divergence. That was your in. That was your longer-term buy, and it stopped beneath it. It did not do what it should have done, which is rally quite sharply up away from it. As we saw earlier, these averages are compressed. So they're essentially at the same level, 224, 225. Not anything here. Again, the best ideal trade has been passed. It was at the pullback zone. So if you are going to engage this, if you're long, great. You're fine. Take a stop if beneath it, but otherwise wait for a valid breakout above at 235. Otherwise, we're just playing very, very short-term ping pong, shorting the highs, buying the lows, and that's not a great strategy, I don't think.
All right. Thanks, Corey. And Mr. Landry.
Well, I'm going to draw my big blue arrow, and as you can see, it's going sideways. So as a momentum guy, no trade here. Obviously, back in March, it imploded a little bit, pulled back. That might have been a little swing trade for you. But other than that, it hasn't done anything in months, so there's nothing to get me excited about this. Now, sometimes these big cap stocks, I will take a setup like this, coming off of all-time highs. It can be a pretty lucrative setup, but as far as a stock that has lost complete momentum and is just going completely sideways, there's nothing for me to do.
All right. And nothing is sometimes a really good thing to do, right?
Amen.
Rather than try to force something and paying for it. All right. Well, hey, gentlemen, let's go ahead and just go one more time around, just wrap up. Any final thoughts you have? And if you have a website or link you wanted to share for the attendees here, and then we'll just close it out. Work done here. So Bennett, any final thoughts and, like I say, a link or website you wanted to share?
Well, thank you, Dean. It's great to be here. And Dave, it's great to be here with you again, and Corey too. Always great to work with you guys. Corey, I think the last time I saw you in person was at the Trade Station event way back. I think that was in 2009, if I'm not wrong. So yeah. Good to see you again, buddy.
You too, Bennett. Good to hear from you. Good day. Absolutely.
Thank you. So it's great to be here. I just want to invite everybody to our website. I guess I'll put a link up if you want to learn a little bit more about our trading tools. I put a link up in the chat area. You can click on that at your leisure. But come by and visit our website. We got a lot of free stuff there, and glad to have you visit us. Okay. So thank you for having me, and everybody, thank you for coming. So Dean, right. Thanks so much.
Yeah, absolutely. All right, Corey, closing thoughts from you, sir?
Well, Dean, thank you. This is the first event. This went really well. I think I learned a lot too. Hopefully the attendees did as well. But thank you for putting this on, Dave Cosminer as well, Dave Landry, and of course Bennett. Glad to be with you all. It's an honor. And when you're trading tactics, if you're new at this or experienced, always look at your pivots, honor your stops, honor the risk management, etc. And I offer a trial, so I don't do a whole lot of marketing and things, but it's a free 2-week trial to our intraday idealized short-term swing trade or short-term intraday trades. And then the other part is a weekly where we look at oil and gold. We do treasuries, dollar, and of course the S&P. So we do 2 different sides of membership: planning, education strategies, risk management, and core principles of price behavior. So we have a lot of fun, try to have fun, overcome our fear. We're not afraid to trade. We're just name of the website. So otherwise we do free blogs at Afraid to Trade for daily commentary.
All right. Outstanding. And Dave Landry.
All right. Great being with you guys, Dean, Corey, Bennett. Corey, I don't know if I'll see you in Vegas or not, but I might catch you there this fall. I don't know where my plans are. I might have some international travel conflicting with it, but looking forward to seeing you there, hopefully. Dean, I agree with Corey. I think you got a winner here. Good show. Learning some things here too. Very good stuff. So thank you, and thank you, David Kosminder, for inviting me back yet again. I'll wrap it up quickly here as far as my part goes. DaveLandry.com is my website. You can click on contact. You can get in touch with me. If you click on this button in the middle of the page, there's about 10 things that'll keep you busy for a long, long time, all of which a lot of paid services and products. Well, I have a trading service where I give out exact signals, which include a stop, as I preached earlier, and along with the entry, obviously, and then a trailing stop, etc. Everything is laid out for you, the complete plan. All you have to do is follow it. That's where the trading psychology comes in. And I talk a lot about the psychology in a weekly webinar. So if you just click on this button right here, everything will be listed. Join me in the webinar on Thursday. If you have any questions about the methodology, bring them then, and I'll be happy to discuss them and go through live charts, similar like we did tonight, which is I think is a winning forum. So anyway, thanks everyone. I really appreciate you guys for attending tonight, and thanks Bennett, Corey, and Dean once again, and of course David Kosminder.
Yeah. Okay. Great. Glad I can say that easily. Glad you could make it, Dave. It's good to have you here. I appreciate your inputs. It's good to have different methods. I think for the for all of us and the attendees to hear some different opinions. So again, I'm Dean Jenkins. FollowMeTrades.com. There's my website. Got my the annual results we're getting here, and I believe in full transparency. So every single trade we've taken for each of the years is listed there in quite detail. Don't take a trade without having a target, a stop, and a specific entry point. And a good way to get started is just to sign up for our free newsletter. I call it Beyond the Noise. Get beyond the noise, all the headlines and news and chaos, and just looking at the reality of price, right? Which that's the only reality in the market: price and volume. And so each week we do an update and give an outlook on the market and some trading ideas. So that's a great way to get started if you're interested in finding out more. Is just to grab that free weekly newsletter. Okay, well, thanks again, gentlemen. Good session. I think the format here was a hit. We'll talk about doing it again and make it a regular thing. And so Bennett McDowell from TradersCoach.com, Corey Rosenblum from Afraid to Trade, and Dave Landry. And his website is easy to remember, DaveLandry.com. And I'm Dean Jenkins from FollowMeTrades.com. And David, thanks for hosting and putting it all together, and for inviting us. And we'll catch you on the next one. So back to you, Dave, to shut it down.
Yeah, Dean, thanks for sharing this idea with me and helping me set it up. And yeah, just for everyone watching, be sure to hit the YouTube subscribe button to get updates on future shows. And if you have any feedback about this first episode, feel free to reply to any Timing Research email, or go to TimingResearch.com and hit the contact button. Any of those messages come directly to me, and stay tuned for future shows. Thanks, everyone.
Thank you.
Right.
Thank you.